Ever pondered why economies, sturdy as they may seem, suddenly collapse? The answer often lies in the deceptive allure of economic bubbles. These are not your everyday soap bubbles, but rather complex economic cycles characterized by a swift escalation of market value, especially within a certain industry or asset class. This rapid rise is usually followed by an equally rapid decrease in value, or what we often refer to as a burst. Now you might be wondering, how does such a bubble come into existence? Well, it's typically created by an excessive surge in asset prices that is unwarranted by the fundamentals of the asset. It's like a mirage of wealth, a false promise of prosperity that many fall for. In essence, these economic bubbles are like ticking time bombs in the economy, waiting to explode and cause chaos. Just like soap bubbles, economic bubbles gleam with promises, but shatter without a warning. A bubble's birth and death is a fascinating chronicle. Let's dissect it, shall we? The life of a bubble begins with the takeoff stage. This is where the smart money enters. It's the early adopters, the savvy investors who see an opportunity before the masses do. They're the ones who kick off the bubble. Then, we move to the mania phase where the public jumps in. This is when the bubble expands, fueled by investor speculation and market sentiment. It's a time of irrational exuberance where everyone believes the price will keep going up indefinitely. But like all good things, this too must come to an end. And so we come to the blow-off phase. This is where the bubble bursts, often triggered by a sudden realization that the price is not sustainable. It's a rapid sell-off, a scramble to get out, leaving behind a trail of financial devastation. Like a tragic play, the final act of a bubble's life is its inevitable burst. The burst of an economic bubble resonates far and wide. But what are its repercussions? Now, imagine a balloon popping. The immediate aftermath is startling, isn't it? The same applies to economic bubbles. Once they burst, the effects are immediate and often severe. One of the most significant impacts is economic recession. Just like the Great Recession that followed the housing bubble burst in the mid-2000s, economies can be sent spiraling into periods of negative growth and increasing unemployment. Investors, too, bear the brunt. Remember the dot-com bubble at the turn of the millennium? Many investors who had put their faith in internet-based companies found their investments wiped out almost overnight. And then there's the change in government policy. In the wake of these financial crises, governments often enact new regulations to prevent similar occurrences in the future. The aftermath of a bubble burst leaves an economy scarred and its participants wiser. But as history shows, the echoes of burst bubbles can be heard for years, even decades later. Bubbles leave behind more than just economic wreckage. They also impart invaluable lessons. Each bubble in its rise and fall unveils the intricacies of economic dynamics, revealing the consequences of unbridled speculation and imprudent investments. They underscore the importance of sound investment strategies, urging us to think twice before jumping on the latest fad. Furthermore, bubbles highlight the critical role of government regulations in maintaining economic stability. They remind us that lack of oversight and unchecked growth can lead to devastating consequences. But perhaps the most vital lesson bubbles teach us is economic vigilance. They instill the importance of keeping a keen eye on market trends and not getting swept up in the euphoria of booming markets, as the fall can be swift and steep. Understanding these lessons can provide economists and policymakers with the insight needed to prevent future economic disasters. In the ruins of economic bubbles lie the seeds of economic wisdom and resilience.